Welcome to Ask Cash. One question which comes to the mind of all entrepreneurs, especially the SMEs, is how do you value your own company? In the days when you hear so much about the Flipkarts and the Amazons and recently the Uber Eats, where the valuations are mind-boggling figures, somewhat multiples of the net profit and then sometimes its losses, you wonder how do you value your company? Unfortunately, entrepreneurs try to compare valuation of brick and mortar businesses, the general manufacturing companies with these kind of companies. These are IT companies, these are tech companies where the factor of scalability is huge. You can be sitting at any nook and corner of the country and you can be delivering the product and service to any nook and corner of the world. This may not happen with a manufacturing concern, and there are some geographical and product wise limitations when it comes to a manufacturing company. So, how do you value a typical SME, a typical manufacturing company? There are two broad methods of valuing such a company. The first one is a multiple approach. So, what is a multiple approach? You look at the deals which have happened in the recent times with comparable companies. Generally, this happens with listed companies, which obviously will be much larger than your size and much secure than yourself, but you can discount that valuation to suit your size of the company. So, what do I mean by that? When these bigger companies, the listed companies, get sold or they are invested into, there's a certain value paid for these companies. You have to compare this value with the sales of that particular company for the latest financial year. You have to compare it with the EBITDA of that particular company, and you have to compare it with the net profit. You'll get a multiple of sale. So, for example, if the value given for the company is 1000 crores and the sale of that company was 1000 crores, it means that it was sold at one time multiple of sales. If the EBITDA say was 200 crores, it was sold at 5 times. That's 1000 upon 200 crores of EBITDA. And similarly, if the PAT is 100, then it was sold at 10 times of its PAT. You have to use these numbers, that is 1, 2, 1, 5 and 2, and then discount it maybe by 50%, by 30% to compare your company's potential valuation as compared to a listed company. Similarly, that might be a non-listed company which has also been acquired into. There are some public data could be available in terms of the valuation of such companies. If it's a private limited company, data on the latest financial when the deal happened would have been available on MCA. You can download that data and then compare these multiples. It will give you a broad estimate of how your company will be valued rather than having some obnoxious valuation which will put the deal off. The other method which is used is the discounted cash flow or the business plan related valuation. Here what you do is you go by a business potential of your company for the next 3 or 5 years. That is, you put together a P&L in terms of what you'll achieve in the next 3 to 5 years. And on the basis of that, you discount it to today's value. So the discounting factor is based on what we call as weighted average cost of capital, which is the average cost of the capital which you have acquired to fund your business. On that basis, you discount it to today's value. And on the basis of that value, you offer your valuation to a person who is buying your company or is valuing your company. Now, the broad fundamental is if you are going to be the runner in terms of delivering that future business plan, then you should offer a discounted cash flow kind of a valuation. But if you're looking at hanging your boots, you're not very sure about the future, then you should look at today's valuation in terms of giving away your company. The only fundamental is that when you're looking at much larger valuation on the basis of the future value, you're also promising to the investor or the acquirer that the business is going to take that much of a multiple jump. If that does not happen, in the legal agreements, there will obviously be clauses which could hold you responsible for this kind of a promising growth. Another method which is used only for capital intensive industries is what we call as a net asset value, where you add all the fixed and the current assets of the company and you reduce all the debts from that company to come down to your net value from that particular company. So it's important to understand what's the best method. Ideally, compare the two methods and then find out which is actually the best kind of a value coming for your company. But be reasonable, understand the market trends also for your industry, which is very important. Your industry plays a role in terms of what value you will get. So these factors will ideally determine what should be the valuation of your company. Provide the right value, see that you're getting a good deal. All the best for your business.